G'day and welcome to this week's video. My name is Ashley Rowan and I'm a financial advisor with Consortium Private Wealth. In today's video, we're going to be looking at superannuation, and in particular for those clients or members who have running two policies at the moment and are trying to decide which policy to keep moving forward. Now, there are many reasons why an individual might have multiple superannuation funds. The biggest reason would be if you were to change occupation or change industry, your employer may set up another superannuation policy on your behalf. Another reason that we've come across in recent times, and particularly specific to our industry here, is that a number of clients have received a refund of old service fees that have been paid out as part of the Royal Commission into the banking and financial advice industry. Now, this was a review which was conducted over a 10-year period. So if a client had rolled out of that particular superannuation policy, it's no longer there. So what they would do is the refund would be provided and a new policy would be opened up automatically in their name. So internally, we've had a number of clients in this position where all of a sudden they've got multiple superannuation policies and they need to make a decision. Now, we don't need, in my opinion, multiple superannuation funds because number one, it is costly, so you're paying a duplication of account keeping and account management fees. From an administration point of view, it is very timely, so you'll be receiving a number of documents or statements in the mail. If you need to process any changes such as investment switches or updating death benefit nominations, it is very time consuming. And not to mention confusing as well, running more than one policy. There are some situations where having more than one account would be beneficial. I can only think of one, and that would be when you're considering retiring or starting to slow down. So in those instances, and that's generally for clients or individuals who are 55 and older, they'll start to transition into retirement. So they might have a super fund which has been rolled into pension phase, so they start to receive a bit of income from that account. However, they haven't stopped working completely. They may work casually or part-time, for example, and we still need somewhere to pay the employee contribution. So we have one account over here in accumulation phase and another superannuation account in pension phase over here, which is just topping up your income, which slowly allows individuals to transition, like I mentioned, into retirement where they retire completely and are just then reliant on the pension account. So that's probably one instance I do believe where multiple funds is beneficial. However, for the majority of Australians, running two accounts, particularly in accumulation phase, just doesn't make sense. As an advisor, we often come into this scenario where a client has multiple superannuation policies and they ask us the question, well, which one should I keep? Now, the answer is not that straightforward. However, this is what we look for. Number one, we'll likely do a fee comparison to work out which policy is potentially the most cost effective. Number two, based on the client's preferences, we look at the investment flexibility within those portfolios. So we may have a client situation where they're happy just to let it go with the flow and don't pay too much interest in how the investments are allocated. There's not too much activity within that. They may be happy with just a sort of a balanced managed fund option, and that's generally suitable for an extended period of time. However, if you're an individual who likes a bit of investment activity, like to have a bit more control over your asset allocation, you may wish to purchase direct shares or term deposits or whatever the investment option may be, then that may have a particular appeal to which platform you do end up moving your total investments to. So investment flexibility can be considered in some circumstances. Another one would be administration support and the quality of the product provider themselves. So how long does it take for you if you send a form away, such as making an investment switch or updating death benefit nominations? How long does it take for that particular company to process that change? With poor administration practices, getting anything done is a painful effort. So you might have a preference to choose one provider over the other based on just how quickly and efficiently they get stuff done. And lastly, technology is a big one. There's a lot of super funds out there. At the minute, we'll have apps for your phone. You can go in and check balances, maybe make switches, or from the comfort of your phone. Otherwise, is there a portal where you can log on and check your balances and do all that activity? So if you're a bit of a technology guru and you like that functionality, that may have a particular weighting on which fund you choose. So to summarise those again, compare fees, the investment flexibility and control that you have, their administration practices and the quality, and also the technology. Lastly, what I'd like you to consider before rolling any funds out of one into the other, just check fees. Once again, the fees, but in particular the exit fees. So how much does it cost for one fund to release your money and then send it across? So double check that before making a decision. And probably the biggest factor here, I don't want you to forget about insurance. As soon as you close an account down, you've lost that insurance forever. You'd have to reapply for it either with your new provider or externally. So if you're very reliant, if that insurance is valuable to you, particularly for those with poor health, you may not be able to get insurance elsewhere. So just double check if you have insurance, and in some cases, in the majority of cases you will, because there's usually default cover offered within a lot of superannuation funds. Just double check your levels of cover because that will be lost once you close it down. So your preference might be to retain the insurance and then roll the fund into that account that has the insurance. And finally, once you've made that decision, you've processed the transaction, you've got one super fund moving forward, the last thing you need to do is update your employer. If they've already got your details, nothing further needs to be done. However, if you've chosen the fund which hasn't received your employer contributions previously, let your payroll people know you're at your business, and you'll receive your ongoing contributions moving forward. Thanks for watching the video. Hopefully it was valuable.